Hey, Dream Team, welcome to another episode of Thirsty Thursday, where I sip on a refreshing drink and bring your thirst for knowledge a quencher, so to speak. So today is featuring Seven Brew. If you haven't been to it, it's phenomenal. I got a triple seven, which has 6 shots of espresso. It features an unobtainium milligrams of caffeine, and it tastes like an iced coffee should. I'm a big fan. All right, back to it. I'm going to talk about what lenders look for out of a potential buyer, which are the 4 C's. The 4 C's of mortgage refer to the key factors that lenders consider when evaluating a mortgage application. And these factors help lenders assess the risk associated with lending money for a mortgage. So the 4 C's are as follows. Number one, the first C, credit. Credit is a significant consideration for lenders. They assess the borrower's credit history, the credit score to determine their credit worthiness. So, a strong credit history with a high credit score indicates responsible financial behavior, and it also increases the likelihood of approval. Lenders examine the borrower's payment history, their outstanding debt, and the length of credit history and types of credit used, as I talked about in another video. The second C, the capacity. That actually refers to the borrower's ability to repay the mortgage. Lenders evaluate the borrower's income, employment stability, and the debt to income ratio. They want to ensure that the borrower has steady and sufficient income to cover the mortgage payments along with other existing financial obligations. Basically, they just want to get paid back. They want to make sure that everything's good. The third C, collateral, and that represents the property being purchased with the mortgage. So the lenders consider the value of the condition of the property as security for the loan. They conduct appraisals to determine the property's market value and ensure it is sufficient to cover the loan amount. The property serves as collateral, protecting the lender's investment just in case the borrower defaults on the loan. So if they can't repay, they get the house. The fourth one is capital, and that refers to the borrower's financial reserves or assets. So the lenders actually look through the evidence that the borrower has enough savings or other assets to handle unexpected expenses of periods of financial difficulty, which we've all had. A higher level of capital demonstrates financial stability and decreases the lender's risk. So, in addition to the 4 C's, lenders also consider other factors when evaluating a mortgage application. These may include the borrower's employment history, down payment amount, loan to value ratio, the LTV, and the purpose of the loan, such as a primary residence or an investment property or a second home. Lenders typically aim to minimize the risk and ensure that the borrowers have the financial means to repay the loan. Meeting those requirements of the 4 C's and demonstrating a strong financial profile actually increases the chances of the mortgage approval. However, it's important to note that the different lenders may have varying criteria and additional factors they consider during the mortgage underwriting process. So sometimes the underwriters ask for more. Again, guys, for more ideas or questions for me to tackle, please comment below. And as always, for more content, mash that like button and click subscribe. Now go make it a great Thirsty Thursday.